Hello, welcome to my retirement roadmap. This is the final video in the series about taxes in retirement. Uh, just kind of some things to consider as we go through this. First of all, let's talk about retirement account beneficiaries because this is really important. I have talked about this in the legal documents or estate planning video series, but basically, when we're talking about qualified retirement accounts, so we're talking about 401k or any of the employer versions like 403b, 457, etc. It is important to name your spouse as the primary beneficiary. This is super important. If you're married, definitely need to name your spouse as the primary beneficiary. If not, so basically you're married and you want to disinherit your spouse for any reason, there are rules that have to be followed. So make sure that you do that, that your employer plan sponsor will walk you through how all that happens. But as a general rule, you need to name your spouse as the primary beneficiary. That's for employer accounts. Now, if you are, if you're looking at your IRA, okay, so either your Roth IRA or a traditional IRA, as far as the primary beneficiary, again, the best thing to do is to make your spouse the primary beneficiary. If for some reason you do not want to do that, be aware that this then follows state law, and so you need to make sure that you follow the state law as far as how your beneficiaries are named. But for now, just keeping it simple, most people are going to make their primary beneficiary their spouse, and that's important for retirement account beneficiaries. Then, when we get to contingent beneficiaries, it is important to name individuals. This is super important. I can't say how many times I've seen it where the contingent beneficiaries are not individuals and they may go to the estate or to a trust, and those things can trigger, like it says, less favorable tax treatment. So you just want to make sure if there's, let's say for example that your estate attorney has said just make the contingent beneficiaries your estate. We'll handle it. Push back. Say why? Why is that? Because I'm learning that that's not as efficient as it can be. So just push back and ask why until you definitely understand what the right things are. Again, having it go to individuals will avoid probate. I think it's quite a bit more efficient if it's going to individuals and they get the tax treatment. And we could spend, well, I just spent 2 days at the EdSlot conference talking about these IRAs and everything. And so there's a lot going on, and naming individuals is the right thing to do unless you have a very complex situation, and then you definitely need to be involved with an estate planning attorney, CPA, etc., to make sure that if you're naming a trust or your estate, that they know what's going on and that's the right thing for your situation. But as a general, for most people, just name individuals, you'll be fine. Okay, so that talks about the beneficiaries. Also, in taxable accounts, you can also do the transfer on death and have that go to real people. And that will also, for the most part, that should avoid going through probate. Just make sure that you've set those up correctly. That's important. Okay. And also this information, if it doesn't go through probate, it's not public information, whereas probate is public. It's open to everybody to see what's going on there. Okay, so let's move on to the last thing about, we call it taxable income considerations. And we could spend, almost an hour on each one of these topics, but I'm just going to give the high level. Typically what happens is you kind of want to sit down and look at your taxes for the year early on and kind of get an idea of what you're planning on doing as far as withdrawing money. Kind of do the first pass at what's going on. Maybe you do that after you've filed your previous year's tax return. So you kind of got that one in the bag. Now let's look at the upcoming year, see where we are, see if there's any levers we want to pull, and then you kind of do that, and then towards the end of the year, let's call it November, okay? You start looking at what's happening, really where you're going to be towards the end of the year, and see about fine tuning everything, because there can be some really good planning opportunities at the end of the year, but you kind of have to wait. Most people have to wait to kind of see where things have fallen out, especially in, like I said, in retirement. Things can be so different and can change much more rapidly than when we are saving for retirement with our regular job. Okay, so let's talk about Social Security. So Social Security is one of the most complex forms of tax treatment there is. And if I couldn't sit down and tell you what it is. I've memorized it several times, but it just goes away almost as soon as I think I've got it memorized, and it's gone again. There's some other situation there. And there are taxable calculators out on the internet that you can look at, or you could get a spreadsheet to kind of try to figure out what Social Security taxation is. But some people are really like, I just need to try to keep my Social Security taxation down. Because if your income is low enough, you don't have to pay any taxes on Social Security. But for most people who have saved for retirement and withdrawing money, and they're paying their taxes on those withdrawals, it is pretty common to go up to the 85%. But there's still 15% of Social Security that is not taxed. And another reason to wait until 70, right? To at least one person in the household to wait until 70 to get Social Security, because 15% of that Social Security won't be taxed. All right, I digress. Let's move on to Medicare IRMA. Some people might say, what is that? So IRMA stands for Income Related Monthly Adjustment Amount. And what that is your Medicare premiums. If you make more, if the household makes more money in their adjusted gross income, again, not to get too detailed here, but the adjusted gross income for Medicare, this IRMA, is your adjusted gross income plus any non-taxable interest that you may have. And that can kind of sneak up on you about that non-taxable interest, because it gets added. And then your premiums are based on the 2 years prior. So, for example, we're in 2026. They're looking at the adjusted gross income from 2024 to determine what IRMA is, what those premiums are. So, long story short, I know at the end of last year, I worked with several clients. We went through and we're like, okay, let's just kind of be careful here, because we're getting close to an IRMA bracket trigger. It's not the end of the world if it gets triggered, but just $1, here's the extreme case, right? Just $1 can trigger that next bracket. So you just want to kind of plan carefully around that, see if you're getting close. It's a good consideration. And we could easily spend an hour talking about Medicare IRMA. I will resist the temptation to discuss any more than that. But again, at the end of the year, you want to be looking at thresholds for your tax planning. And then capital gains rates. If you have capital gains and you want to, you have unrealized capital gains and you're in a low capital gain rate, for example, again, this is at least an hour's conversation, but something to consider. If you're in a low rate for whatever reason, okay, you could possibly harvest some gains. That's what they call it, harvesting gains. Sounds interesting. If you're not familiar with that and you have a taxable account, it's good to get some help with this. This is something that's not super intuitive to most folks. Okay, and there's just something to consider. We're talking about those capital gains rates. We look at that at the end of the year. Then there's this other little tax, net investment income tax. This one's a tricky one. It really impacts people who typically for higher income. Okay, and this was a tax that was implemented years ago that doesn't typically hit most people, but it can. I know for Jeff and me, it snuck into our world. We had a rental condominium that we had invested in, and we sold it. And so I was doing the taxes, and all of a sudden this thing pops up, and it was because it was capital gains. I mean, we made a good return on that investment, And then all of a sudden we had this net investment income tax that I had no idea existed. This is years ago. So it comes into play, something to be cognizant of, and that was also something that we look at the end of the year to see, if we're moving into that area, is there something we could do to minimize that impact from the net investment income tax? Then we have this new senior deduction. It's a temporary thing. This is for people who are 65 and older. A senior deduction, $6,000, but it phases out. So I've worked with clients. I worked with clients at the end of last year because it came into effect for 2025, and we were like, okay, we need to be careful because if we're doing a big Roth conversion, that senior deduction could just evaporate. Is that something that we want to do? Again, something to just really pay attention to as you do your tax planning. Then we have this SALT deduction. Now, what's SALT? The SALT stands for state and local tax deduction. For years, it was capped at $10,000, and that kind of hurt people who are in high tax states like California, which is where I am. I think New Jersey and New York are the other two big state. I believe those are the other two states that get talked about when it comes to this state and local taxes being high. So they have changed it such that you can now deduct up to $40,000. However, it's phased. That's another. So you want to make sure if you're, doing, for example, doing a Roth conversion or you're pulling money out of your tax deferred accounts for some purchase or a big vacation or something, you just need to be aware that that could impact the SALT deduction as well. Finally, one more thing to consider when talking about taxes are charitable deductions. Okay, now we talked earlier, one way in a tax deferred account you can avoid paying tax on that by giving the money to a qualified charity. And there are also QCDs. I didn't mention those, qualified charitable distributions, and that can help as well. And that, if you do a QCD, you're giving this money away, and there's basically a limit about how much you can do, but it's available. Congress changed charitable deductions starting in 2026, and this is another consideration because people who itemize deductions, now they've got this 0.5% threshold that needs to be met before charitable deductions kick in. And also there's if you're really high up there, I think that it's capped at 35% as the most, depending on what tax bracket you're in. So that's another change that came into place for charitable deductions. However, on the other side, if you're not itemizing deductions, there is a way now for people to take $1,000 as a charitable deduction if you're not itemizing deductions. So that's a good benefit for people. It's helpful. Anyway, I think I've talked enough about these taxes in retirement. We're seriously, we're just barely scratching the surface. But the challenge is that this really impacts people in a totally different ways. It just depends on how they come in with their, the savings when they retire, how that's all set up to what really applies and what works. I highly recommend, if you're not familiar with taxes, that you do reach out to a professional to help navigate this, both from a long-term perspective and also for the current year. Thanks.